Alphabet, which is the parent company of Google and right here on YouTube, just announced some big news. Not only their Q1 results and how their earnings went, but also the fact that they're going to start paying a dividend. Now, there's some caution that we need to look at here when it comes down to paying this dividend, but also how does this impact the S&P 500. Now, if you're an ETF investor like myself and you invest in something like the S&P 500, this will actually benefit the S&P 500 dividends. But let's dig into the details. Now, the very first thing we should look at is the fact that, congratulations, yes, Google is now paying a dividend. This is very rare for a high-tech company, but it does eventually get there. We just saw that Meta, the owner of Facebook, announced a dividend payout. But a lot of times when companies are just starting off and they're in their growth phase, their building phase, they need to take as much money and as much profit as possible and reinvest it back into the business so they can continue to grow or potentially pay off a lot of their debts. Now let's talk about what this dividend is and how it impacts the S&P 500. This dividend was announced for 20 cents per share. It'll be paid somewhere around July 17th. It isn't the biggest dividend in the world. 20 cents per share, if you think about how much Google actually trades for and the value of that overall stock and company, that comes out, assuming that they're going to continue to pay that dividend every 3 months or 4 times per year, that dividend yield is only 0.51%. Now that's significantly lower than the S&P 500 standard, which is right around 1.3%. But in any case, it's nice to see one of the big Magnificent 7 companies pay out or start paying out a dividend. But let's take a look at the yields of some of the most valuable S&P 500 stocks. Now, right here you see some of the top holdings, but also you're going to take a look here at the dividend yields. You have ExxonMobil, been around forever, has been in the S&P 500 for a very long time at 3.14%, followed up by JP Morgan, 2.3%. Broadcom, so on and so forth. We can see now here is Google as well. And also we should have a proper laugh at NVIDIA's dividend yield. That's something else. You know, enjoy those pennies. They could go far. But when we have companies such as Meta and Google making these big announcements, even though they may be smaller, we should still be excited about the fact that they are still a growth company, so their dividends are going to be lower, but they're starting to award shareholders with additional dividends on top of continued growth. Now, some may argue that could mean that growth is starting to decline because now you're going to continue to maintain and not grow as fast and pay out the dividends and just maintain as a nice stable company. We'll have to see. Remember, 0.51% isn't a whole lot. But how does this impact if you have something like SPY, if you have VOO, or one of those S&P 500 ETFs? How does that work? Have you ever wondered? If you've wondered and you don't know, what occurs when it comes down to an ETF like VOO? The very first thing is because they own all of the individual companies that are paying those dividends, the ETF starts collecting all those dividends typically on a quarterly basis, every 3 months. As the ETF collects all of those dividends, what they do then at that point is they aggregate those dividends, and after deducting any expenses, they distribute them to the ETF shareholders. This distribution usually happens on a regular schedule, typically quarterly. So if we hop over to Seeking Alpha, we type in something like VOO, you can see on the right-hand side, it tells you what the dividend yield is. We're looking at 1.38%. And again, that is a typical percentage yield for an S&P 500 ETF. If we go to the dividend tab here on Seeking Alpha, you can also see when the last quarterly payment was. Right there it is. Ex-dividend date, 3/22, paid out on 3/27, in the amount of $1.64 for every share that you own. You own 1,000 shares? Got yourself $1,000. It works just like that. But one thing to keep in mind is where do you hold your S&P 500 fund? Now, of course, if you have a Roth IRA or some other tax sheltered account, that's fine. But if you have it in any old fund, which I do, so I'm subject to this, just be aware of something called taxation. So you can get taxed based on dividends because even though they may be reinvested back into VOO or SPY, because they're considered a payout, you still would owe taxes on that payout. So if you look at the earnings report that was just released today by Google, you can see Google Search brought in $40.3 billion in 2023. For Q1 2024, look at that, $46.1 billion. Look at YouTube ads, $8.09 billion. Thank you for watching YouTube. It helps with that, and it helps me, and I do appreciate it. But anyway, this is a very positive thing. They're continuing to show growth in the overall Alphabet Google ecosystem. And that company not only offering a dividend, which is positive news, they are also doing a share buyback. Now, how you can look at share buybacks, the easiest way is hop over to Seeking Alpha. What we're going to want to do is go over to where it says financials. Right up here at the top, you have Google, financials. Then what we're going to want to do is click on the balance sheet. If you click on the balance sheet, you come down here, what you will see is total outstanding shares. Do you see that? Total common shares outstanding. Now, what they have decided to do is buy back their own shares. Now, the benefit of doing that and investing a significant amount of money, if I recall, it said it was about $70 billion. Is that right? Yeah, look at that. $70 billion they're going to buy back of their Class A and Class C shares. That is significant. That's going to reduce this number. So keep your eye on this, especially if you subscribe to Seeking Alpha. If not, get yourself a discount. Link in the description below. But most importantly, keep an eye on that. As that goes down, that's a positive sign, because at the end of the day, remember, less equals more. Companies will issue new shares outstanding. They do that because they're trying to raise capital so they can have this money and they can start introducing new products, new this, new that. That is the name of the game. That's why people issue shares. When they buy back shares, that means we've been doing so well that we're going to buy all these back, which in turn makes the price and the growth and the value more exciting and more profitable for the investors that have held over the long period of time. So this is nothing but great news. But I gotta warn you, if you're a dividend investor and you're looking at this and you're like, I'm going to invest in Google because now it has a dividend, I would be like, hey, take a look at that for a second, because remember, we're only talking about 0.51%. That's like getting excited about Apple's dividend or Meta's dividend. Those are still strong, growing tech companies. So maybe over time we'll see a higher dividend yield. But for now, the exciting part is that they're starting to pay, but we'll have to see. What are your thoughts on the fact they started announcing a dividend payout? Comment down below and let me know. Now make sure you check out this video next, and we'll see you on the next video.